Hello, my name is Brenton Harrison with Ultra Borrowers Academy, an online course where we help people with a mountain of student loan debt turn around their financial picture and take back control of their student loan burden. We're back with another video today. We wanted to give you a quick video where we explain some of the things that you might have heard if you're a married couple that have a student loan balance. And for married couples who use federal student loan payment plans such as income-driven plans, where you base your payment off of a percentage of what's called your discretionary income, you might have heard in the past that it can benefit you in terms of lowering your payment to file your taxes married filing separately. So you've had that conversation with your spouse, you've talked about it, but you maybe not understood, or you maybe haven't understood exactly what that means, why it helps with student loans, and whether it's actually the right thing for you to do. What are the pros? What are the cons? What are the consequences of making that decision? So that's what we wanted to talk about today. And when you talk about federal student loans and income-driven plans, we always go back to just an overview of how these plans work. You've seen our past videos. We go through this every time, and I understand that you may not like the repetition, but to me, the more you repeat, the more you understand, the more you can drive home these principles. So there are a number of what's called income-driven plans that are offered by the federal government when it comes to paying your federal student loans. And as a recap, the payments under these plans have no connection at all to your student loan balance. The same example applies if I owe $1 million in student loans and you owe $100,000 in student loans, but we have what's called the same discretionary income. We're going to have the same student loan payment under these plans, even though I owe 10 times more than you. It's all based on a percentage of this discretionary income, and it has no connection to your loan balance at all. Now, in terms of what's relevant to today's session, the calculation for discretionary income starts to give you an idea of why some couples may be considering filing their taxes apart from each other. Because to find your discretionary income, and you pay a percentage of this each year, the government is going to, or your loan servicer is going to do a calculation where they take your household pay and they subtract 150% of the federal poverty level. And if they're taking your household pay, which they typically or often find from your tax return, it makes sense that when you're doing this calculation, that if you can find a way to have your spouse's income excluded from this calculation, it would in turn lower your discretionary income, which in turn lowers your loan payment. And that's the key that a lot of people are looking at in terms of whether they should file their taxes separately. Because if you file your taxes separate from your spouse, when you turn in your individual tax return and do this calculation, you can effectively have their income excluded depending on the type of income-driven plan that you choose. And this is an important distinction. All of the income-driven plans do not allow you to exclude your spouse's income. It's only two that offer this benefit, and that's part of what we're going to get into today. The first of these two plans that offers what's called a married filing separately exclusion, which is essentially allowing you to exclude your spouse's income if you file your taxes separately, is what's called the income-based repayment plan. So think of like this big umbrella of plans. There's income-driven plans. That's what all of them who fit under this umbrella are called. And then under that umbrella, there's a particular type of repayment plan called the income-based repayment plan. That's something that's often misunderstood. People think that there's only one type of plan, or that when I say income-driven, this is what I mean. But income-based repayment is just one form of income-driven payment plans. The income-based repayment plan does offer you the married filing separately exclusion, where if you file your taxes separate from your spouse, you can effectively have their income excluded from the payment calculation. And the second plan that offers this exclusion is what's called the pay-as-you-earn plan. So we have the income-based repayment plan and the pay-as-you-earn plan, both of these plans offering the same married filing separately exclusion. But now we have to get to the conversation of what does it mean to file my taxes separately, and is this something that I should do, or are the consequences of doing so more than the pros that I would get in terms of a benefit? Well, before we get to that, let's first do a quick breakdown of Taxes 101. This is an extremely high-level overview of how taxes work, but I want to familiarize you with some of the technical terms, the phraseology, so that you have an understanding of what you're sacrificing when you file your taxes separately. So when it comes to taxes, the first thing that you have to do with taxes is you have to find your total income. That is your salary, your base pay, your bonuses. If you have any side hustles, your side hustle income. If you are divorced and you're receiving alimony, alimony actually counts as a part of your total income. Child support does not, but alimony counts as income. You total all of those sources up and you find your total income. This is what you made from all sources throughout the course of the year. Then you have tax deductions. And a tax deduction is a tool that is actually used to reduce the amount of your income that you have to pay taxes on. An example of a tax deduction would be something like the amount that you gave to charity. It would be something like the amount that you put into a retirement account in some instances. All of those things are used to take that total income number and lower that amount so that when you actually pay taxes, it's on a lesser amount than what you actually earn. That is a tax deduction. It reduces the amount that you pay taxes on. Once you find the amount that you pay taxes on, you've used up all your deductions, everything that you've done has been accounted for. Whatever's left is considered your taxable income. So even though you made more, your taxable income is the amount that you actually will have to pay taxes on. So you do that, you figure out how much you have to pay taxes on, and then you're going to apply it to the tax code. We'll show you an example in a second, and you're going to find what you actually have to pay in taxes. Now, after you find what you have to pay in taxes, that's not actually the end, because there are tools that are called tax credits that actually reduce the amount of money you pay in taxes. So let's look at a quick example, really high level. Let's say you have $100,000 in total income and you have $10,000 in total tax deduction. Remember, a deduction reduces the amount of your income that's subject to taxes. So when you take those tax deductions away, you have $90,000 of taxable income. This is the amount that you're actually going to apply to the tax bracket to see what you owe. So you take that $90,000 and let's assume that you're paying 10% in taxes. Well, after you do that calculation, you'll find that before tax credits, you owe $9,000 in taxes. But if you have $1,000 of tax credits, that would actually lower your total taxes owed by $1,000 to $8,000, and that's what you actually pay. This is a representation of just the tax flow process. It's much more involved, much more complex when you have an actual tax return, but this is just kind of a grand overview, overarching view of how this process works. Now, why is all of this relevant to the decision to file separately versus filing together as a married couple? Well, when you file married filing separately, the good thing is that you remove your spouse's payment from your adjusted gross income calculation and your discretionary income calculation. So when it comes to calculating your student loan payment under those two plans only, you can effectively remove your spouse's income from that calculation. And that does seem to be a positive. Another positive is that it allows you to keep your spouse and children in the calculation when it comes to determining your federal poverty level. And we're going to do a quick recap of what that means so you can understand why that's so powerful. Going back to the formula for discretionary income, you can see that the calculation for discretionary income is your household pay minus 150% of what's called the federal poverty level. The federal poverty level is an amount of income based on how many people in your household, where if you make that amount or less, you're considered impoverished. It's the amount of income that the government uses to determine who's eligible for certain social services. And the more people in your household, the higher that federal poverty level is. And you can see based on this calculation that if you can have a higher federal poverty level, it will reduce your discretionary income, thus reducing your loan payment. You can see here in 2019, the federal poverty level for a household of one was $12,490, but it goes up significantly for a family of two and for a family of three, so on and so forth. And in that calculation for discretionary income, where you're subtracting 150% of these numbers, you can actually, if you file your taxes separately, still include your spouse, still include your children in terms of determining how many people in your household. A quick example would be if like take for myself, I'm married with a child. Well, we have 3 people in our house. If I were to file my taxes married, filing separately from my spouse under these income-driven plans, I would only have my income included in the calculation, but I would still be able to use the federal poverty level for a household of 3. These are the pros of being able to file your taxes married, filing separately. But there are a number of cons, and understanding those cons goes back to understanding the phraseology of a deduction and a credit. Because when you file your taxes married, filing separately, you lose out on a tremendous number of tax deductions and tax credits. For example, the Child Independent Care Credit, which is a tax credit that you're eligible for if you're caring for a dependent child. It's a significant credit that can be helpful when it comes to filing your taxes. The Earned Income Credit is another significant tax credit that's very helpful in terms of reducing the amount of taxes you actually have to pay. And when you file your taxes separately, if you earn too much money and that threshold is not as high as you think, you're actually limited in terms of your ability to deduct the contributions that you put into traditional retirement accounts. And you can even put yourself in a position where you are ineligible to contribute to a Roth individual retirement account. Also, even if you're under the income where you could claim the student loan interest deduction, which many of the ultra borrowers are not, they earn too much money to claim that deduction. But just in case you are under that threshold, when you file your taxes married, filing separately, it is unlikely that you'd be able to use the tax deduction for the interest that you pay on your student loans. All in all, you lose a tremendous amount of benefits that are used to lessen the amount that you pay in taxes when you file separately. But that actually, in my opinion, is not the most damaging part, because the most damaging part of filing your taxes married, filing separately, is it subjects you to a much more punishing tax code as compared to married filing jointly. And to understand that, we're going to look at a tax bracket so you can see what it means to be subjected to a more punishing tax bracket. It's highly likely that if you've heard somebody talk about taxes, you might have heard them complain about being in the 32% tax bracket or the 24% tax bracket. They say, oh man, the tax man is killing me. I'm in the 24% tax bracket. And that somewhat implies that they're paying 24 cents on the dollar for every dollar that they earn. But that's not how taxes work. We live in what's called a progressive tax code. And what that means is lower levels of your income are taxed at different percentages than the higher levels of your income. As you earn more, different levels are taxed at different percentages. Let's look at the 2019 tax brackets for a single person. So you can see the tax brackets on the left, and then the second column is the single person. Let's say that they make $100,000. Well, what that would mean is, even though they make $100,000, all of the money they earn from $0 to $9,700 is only taxed at 10%. Every dollar from $9,701 to $39,475 is taxed at 12%. Every dollar from $39,476 to $84,200 is taxed at 22%. And if they earn $100,000, the only portion of their income that falls in this 24% tax bracket is everything they earn from $84,201 to their $100,000 of income. So while they fall into the 24% tax bracket, it's only about $15,000 or $16,000 of their money that's actually taxed at 24%, and everything below that is taxed at a lower level. Now, the bracket that they fall into for the top portion of their taxes or their income is called their marginal tax bracket. That is, the highest portion of their income is taxed at this bracket. When they total up all these other areas and figure out the average tax that they actually paid, that's what's called their effective tax bracket or effective tax rate. So you might have a marginal tax rate of 24%, but your effective tax bracket, what you actually paid in taxes, may be 10% or 15%. It's typically a much lower number. Now, why is this relevant to student loans? Well, I want you to take a look at something. Every person who's single who earns $100,000 has the first $9,700 taxed at 10%. But let's say that you're a married couple who earns $100,000 together and you file your taxes married filing jointly. Well, you can see that at 10%, they literally have double the amount of money that they can have taxed at that lower bracket. The same is true for 12%. Double the amount of money is taxed at 12%, all the way up to $78,950 as compared to a single person. And if you had a married couple earning $100,000, you can actually see that $78,000 from $951 up to their $100,000 of income is only taxed at 22%, whereas they would fall into the 24% tax bracket if they were single. So not only are they in a complete lower tax bracket in terms of their marginal tax bracket, because they have much more money taxed at these lower levels, they will likely have a significantly lower effective tax rate as well. This all ties into filing your taxes married filing separately, because when you file your taxes married filing separately, guess what tax bracket they effectively use? That of a single person. If you file your taxes separate from your spouse, then on your income, you're going to have to pay a single person's tax rate. And on their income, they're going to have to pay a single person's tax rate. So you are effectively giving up the opportunity to have a much more forgiving tax code applied to your actual income because you made the decision to file your taxes separately. It is a big, big decision. And in the majority of cases, not all, but in the majority of cases, couples who earn a good income pay significantly more by filing their taxes separately than they do by filing their taxes together. There are some circumstances where it works to your benefit, but it's definitely a big decision that goes much further than just the impact on your student loans. So how do you decide how you should file? Well, it's pretty simple. When you're looking at deciding to file your taxes separately or filing together, and also looking at the impact it has on your student loans, filing taxes separately only makes sense if the savings that you're receiving on your student loan payments exceeds the potential increase in your tax burden. Give you a quick example. You do not want to cost yourself $1,000 a month in extra taxes just to save yourself $200 a month in student loan payments. You want to make sure that it works out in your favor. If you're saving yourself $100 a month in student loan payments, but you're only costing yourself $20 a month in extra taxes, it might make sense. Or if you're saving yourself $500 a month in student loan payments and you're only costing yourself $300 a month in taxes, well, that still works out in your benefit. You're still on the positive side of that equation. But you want to make sure, if you're deciding to do this, that you actually engage with a tax professional. And you ask them, I want you to run me a scenario. I want you to show me the difference in what I'll pay in taxes with my spouse if we file our taxes together versus what we would pay if we filed our taxes separately. Then you can take that and you can calculate your loan payment and what the difference would be if you did your loan payment filing together versus filing separately. And comparing those numbers and contrasting them will give you an idea of what the best path forward is for you and your family. I hope this was helpful for you and that this gave you some more common sense language that you can use in terms of understanding not just taxes, but also their impact on how you file student loans as a married couple. We covered the two plans that allow you to have the married filing separately exclusion. And in a future video, we're going to cover the revised pay as you earn plan, which is another form of income-driven plan that gives you the opportunity to have a more streamlined or cohesive approach in terms of how it calculates your spouse's income when it comes to your student loan payment. Since the revised pay-as-you-earn plan doesn't have the married filing separately exclusion, we are going to do a separate video with that plan when it comes to how it impacts married couples. But again, hope this was helpful. This is Brenton Harrison of Ultra Borrowers Academy. If you want more information on our course, you're welcome to visit us at ultraborrowers.com. If you want to stay tuned for future videos, we invite you and encourage you to subscribe and to sign up for the notifications so that you can be alerted of when we drop new material. I'll see you soon. Have a good one.